This diagram maps the 24-hour global cycle. The market doesn't operate at a steady, continuous hum. Instead, it is punctuated by specific windows where global financial centers overlap. Right now, we are looking at the Asian and early European sessions. Watch what happens right at 8 a.m. Eastern. The massive volume of the New York Open drops in and floods the already active European market. This creates a 4-hour intersection from 8 a.m. to noon. This is the golden window. It is where the deepest liquidity and the highest volume of the entire day occurs. Surviving the New York session requires you to abandon the mentality of working a standard 9-hour shift. You need to treat this 4-hour overlap as a highly mechanical, unforgiving environment. To leverage that 4-hour window effectively, you have to ignore the minor crosspairs. Your focus needs to be exclusively on the major US dollar pairs. High volume brings a direct mathematical benefit. Because millions of orders are processed every minute, the distance between the buy and sell price compresses. That tight spread makes entering and exiting your positions significantly cheaper. This matrix shows our baseline asset for the morning session, the euro versus the US dollar. Driven by the massive flow of capital between the Eurozone and the US, it commands the highest volume bars and the tightest spread costs. Because the liquidity is so deep, the euro can absorb economic shocks better than other currencies. That results in the relatively smooth, predictable price trends mapped out here. Now look at the primary alternative, the British pound versus the US dollar, commonly known as cable. The spread costs are slightly wider, but the volatility profile is significantly higher. Here is the trade-off. Trading cable gives you access to much larger potential pip movements, but you have to absorb the pound's tendency for sharp, erratic retracements. It will test your trade management harder than the euro will. It is tempting to trade both of these pairs during the morning overlap. Do not do it. Because they are both heavily tethered to the US dollar, taking positions on both simultaneously often leads to severe overexposure on the exact same market moves. Choose the Euro USD to optimize for predictability and low cost. Choose GBP USD if your strategy relies on aggressive momentum and you accept a higher risk of volatility. Regardless of which pair you choose, you have to survive the most dangerous 60 seconds of the trading day, 8:30 a.m. Eastern, the exact time major U.S. economic data drops. When inflation reports or non-farm payrolls hit the wire, institutional algorithms instantly reprice the assets. The market reaction is violent and immediate. Retail traders routinely fall into a specific trap here. They try to guess the direction of the news before the release, hoping to catch an instant 50-pip spike to grow their account in seconds. The mechanical reality of trading at that exact moment is entirely different. Spreads widen massively, and severe slippage occurs. Your stop loss will likely trigger and close your trade at a loss, regardless of whether you guessed the overall trend correctly. Your primary defense against this institutional noise is a strict, rule-based strategy. This flowchart breaks it down. You either trade instantly and risk the red stop-out box, or you implement the 15 to 30-minute wait protocol. The first phase of this protocol requires you to step entirely aside. You let the initial algorithmic buying and selling fight for dominance on the chart, while keeping your capital out of the market. Once that initial chaos settles, the noise drops away. Only then can you identify the genuine institutional trend and safely execute your entry. The trade-off is clear. You deliberately sacrifice your chance to catch the absolute bottom or top of a price move. In exchange, you secure market confirmation and ensure your account actually survives the morning. Even outside of major news events, the sheer volume of the New York and London overlap guarantees much wider price swings than you will ever see in the Asian or early London sessions. A standard 15-pip stop loss that keeps you safe at midnight will almost certainly fail at 9 a.m. The market's normal breathing during this overlap is simply too deep. To calculate dynamic stop losses, look at this split-screen graph measuring the average true range, or ATR. It shows the narrow Asian session channel on the left compared to the massive, expanded New York channel on the right. If the ATR dictates you need a wider stop-loss distance to survive the swings, you must proportionally reduce your lot size. That equation is the only way to keep your total dollar risk identical across different market conditions. As the morning progresses, you must prepare for the 10 a.m. reversal. European traders often begin taking their profits around this time, which frequently causes a temporary flip in the momentum of the morning trend. Then comes the major structural shift of the day. After 12 p.m. Eastern, European liquidity begins exiting the market. By 1 p.m., the London market is officially closed. Holding active trades into the U.S. afternoon carries severe consequences. Because liquidity plummets, spreads begin to widen. The price action loses its volume-driven momentum and becomes choppy and directionless. Trading the New York session requires dynamic risk sizing in the morning and the discipline to walk away entirely when European liquidity exits in the afternoon. The New York session is a highly technical environment. It actively punishes impatience, but it heavily rewards disciplined execution. This matrix maps out how to align your approach. If you are a beginner or risk-averse trader, stay in this top left quadrant. Avoid the GBP USD entirely, focus on the stability of the EU USD, and strictly adhere to the 30-minute post-news rule. Conservative traders operate strictly between 9 and 11:30 a.m. Eastern, avoiding news spikes and the afternoon fade. Advanced momentum traders operate in the bottom right quadrant, leveraging the GBP USD's aggressive swings during the opening overlap, relying on ATR-adjusted stops. Regardless of your specific profile, surviving the daily volatility of the New York session mathematically requires you to minimize your baseline cost of entry. When price action is swinging violently, executing trades on a platform with wide, variable spreads puts you at an immediate, compounding disadvantage. You are paying a heavy premium just to enter the fight. That makes institutional-grade execution and 0.0 pip spreads a mandatory defensive tool, not a luxury. Having raw pricing, like what FXNX offers, ensures your tight stop losses aren't prematurely triggered by broker markups. Mastering the New York session doesn't mean grinding out a 9-hour shift. It means marrying strict timing, precise risk adjustment, and an account infrastructure like FXNX that works for your strategy, not against it.